right. Well, hello, everyone. On behalf of the Counselors of Real Estate, welcome to this presentation of Vacant to Vibrant, the keys to commercial conversions. Thank you for joining us. I'm John Henschel, CRE, the Global Chair of the Counselors of Real Estate and President of Henschel Real Estate Services in Abingdon, Maryland. The Counselors of Real Estate is a distinguished solutions-focused consortium of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, counselors reside in 25 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation, a badge of distinction, and a commitment to excellence. Let's recognize the exclusive sponsors for this event today, Equus Capital Partners and RELPI. Thank you for your partnership. Before we begin, I'd like to offer you a free digital subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. It's been named one of the top 10 essential real estate publications in the U.S. You can visit cre.org/REI to subscribe. You're encouraged to utilize the Q&A features should you wish to submit a question. Your participation is welcome. And we'll answer as many questions as we can. I'd like to introduce Jonathan Schein, who's going to be our moderator today. Jonathan is CEO and Executive Director of RELPI. And Jonathan, welcome. And
Thank you.
I look forward to a great presentation today.
Thank you very much, John. And thank you, everybody, for joining us across the world about this webinar, Vacant to Vibrant. I'd like to introduce panelists. I'd like them to introduce themselves, starting with Palmer. Please introduce yourself and who you are and what you do.
Great. So my name is Palmer Dobbs. I'm a managing director with Brookfield, and my primary responsibilities with Brookfield are really working with our origination team to help source investment opportunities for our real estate credit platform.
Great. And our gentleman from Vanbarton Group, Alex.
Sure. Hi, everyone. My name is Adam Barron. I work here at Vanbarton exclusively on the acquisitions business, where we're focused on office residential conversions, as well as office multifamily and a few other distinct asset classes. And I'll let Alex introduce himself.
Yeah. Hey, everyone. Alex Tendler here, a vice president on the asset management team. So more on the kind of oversight of our development projects and involved with our construction team's design, as well as, really managing our existing portfolio of other commercial assets, commercial office, retail, stabilized, multifamily as well.
Great, thank you. And just to reiterate what John Henschel had said, if you have questions, please put them in the Q&A and we will try to address them as we can. But what's really exciting about this is something that's been going on for a long time, and perhaps the pandemic definitely hypercharged it, was moving from what do you do with this vacant office space and maybe obsolete office space? What do you do with it? And what we're talking about is, obviously in this particular webinar, is converting that over to residential usage. And in this case, we're going to talk about a case study that's actually happening in real time, which is the conversion of 6 East 43rd Street in Manhattan, a very large old-time office building, into residential. So I'd like to start with Adam, as you are on the acquisition team. Can you kind of walk us through how the process went and how you got to that place where you said, yes, we can do this?
Yeah, absolutely. So there are a few key components, and one of them is finding the right office building from a physical makeup, but also the building needs the right story. So it needs to be the right age in which you can convert it, which I know we'll get to later with a few policy changes in New York City. But one, this building you're able to convert as of right, as is. Two, the basis in the building, you have to make sure that we're hitting our yields and returns that our investors require. And three is the physical makeup of the building. What does the light and air look like? Will this building be an office building that can be converted into something that really works for residential, that will give a luxury feel to its future tenants? And for us, the answer was yes on all three. We were able to talk directly with the owner of the building on this one and have those preliminary conversations and get to a deal.
Okay, and so when you go through that, I mean, how long is that process from, say, we have an idea, someone brings you the property to the closing? How often, and we'll get into Palmer in a second, but how long does that process usually take?
Yeah, so it can depend. We've had deals that have been years-long process of waiting, learning, waiting for zoning. So there's another building that literally we had first toured in 2015, and the deal hadn't actually materialized until just this year. So patience is a virtue, and there's lots of deals there. On the other hand, we have deals that are much quicker. So 60s 43rd, for example, we took a look at the building in March, and we're negotiating a contract about 6 weeks later, ready to go full steam ahead with money down. And when you have a group that has experience here, we know exactly what to look for, what's going to check all of our boxes. And as you do these reps, you can go quicker and quicker. Now we can see a building, and I'd say within a month we can be ready to go.
Wow. So, and with Vanbarton Group specifically, this was not your first rodeo. This is what in the pantheon of things, this is like your fourth or fifth conversion?
Yeah, so this is our fourth one this year. In Vanbarton's past, we've been lending on these deals going back a couple of decades. So in total, this is deal number 15 for us in the conversion space.
Wow, I didn't realize that there had been that many going on, and they were all in New York City, or you're doing it across the country.
Yeah, so previously they had all been in New York City. We're working on one deal in Seattle right now, a conversion out there. That being said, we're looking and very close to a couple of deals in Boston, San Francisco, and a few other markets. So I'd say while New York has been our key focus, as the other cities begin to allow for tax incentives and other types of law changes that allow office to resi to really pencil, I believe you'll see Vanbarton, San Francisco, Boston, Seattle, and a few others.
Okay, so we'll get into the political aspect of that in a second. Palmer, it's not like people are shy about coming to you with deals and how they work and will they work. What is the process? Certainly, I mean, everything starts with financing and getting capital to make these deals happen, to close on the deal, to do the construction and everything else. What is the process that one needs to go through to, especially now with office to residential? We'll just talk about office to residential because that's a very specialized spot in real estate right now. What is the process?
Yeah, and I'd say very much in the same way that the equity process varies deal by deal, the debt process varies deal by deal as well. And it really comes down to the timeline that's required, particularly if it's an acquisition in order to close a loan. So, obviously, Adam and Alex on the equity side, they are spending a lot of time early on trying to uncover those opportunities and really build up the development opportunity. On the debt side, we definitely come in a little bit later. We've got a great relationship with the Vanbarton team, and so we try to stay in constant contact and give them feedback as they're looking early stages on a transaction. But we're really not getting involved in earnest until they've gotten to the point where they've got it tied up and they're under their due diligence period and looking to raise the capital to ultimately close the transaction.
What is the yay or nay point for one of these deals for you to get it to IC or however it works where you are?
So I mean, a lot of
I don't just mean Vanbarton, I meant just along because you get calls from a lot of different organizations.
And I'd say we can get into the details on kind of the merits of any individual investment, and it's a lot of what Adam mentioned on the equity side. The one thing that he didn't mention that is really important to us on the debt side is who the borrower is. And so we want to make sure that we are partnering with a sponsor who's got experience and expertise to execute this type of business plan, because they can often be complex, renovation and conversion projects. And so we've been very fortunate to work with Vanbarton on a number of these in the past, and they're really one of the best in the industry at executing this type of conversion project.
So why don't we talk about 6 East 41st Street because it is the case study in play right now. Why don't we talk about the building itself? Can you kind of tell us about the bones? What is special about this building? What is its special sauce? What makes it appealing to make a conversion? Because there's a lot of office buildings out there that people are saying, yeah, we'd like to do this, but it may not work or it will work. So what was it that was compelling about this particular property?
Yeah, I think a few things, and kind of going back to what Adam mentioned about the ability to convert the building as of right, I think is essential, and not needing to go through extra hoops essentially to be able to build. And the second part of that really for us is de-risking the office building as much as we can. And in this situation, effectively having a vacant building for us when we close. So there's a ground floor retail tenant who's still in the space, but having a building that you don't need to negotiate with the tenant, take on the risk of needing to pay them out perhaps, and really seeing that play through. And I think Palmer would probably say this as a kind of going back to your previous question, is a point that they look for. Having the cleanest slate possible from the actual building, I think is really important. Second to that, I would say is location. So, you don't typically think as, a Bryant Park, 42nd Street corridor, as really residential. And I think with the city's initiative to really allow for more zoning, so the City of Yes, and other initiatives, there now are other projects kind of on the 42nd Street corridor, a little further east of ours, a little further west of ours, that are starting to pop up. And with the amount of, corporate offices around this area, it really provides a good, I would say, rental base of renters and people who are going to need places to live. So you think of, okay, JP Morgan's, 270 Park Avenue, which, just was completed earlier, I think in October. So, all of these new grads, 25, 30, 35-year-olds, with these options here, it's a great opportunity for us to kind of pick off some of these, these workers and really be in a market that's new, as opposed to, for example, some of our projects downtown in the financial district, much more residential in nature. It doesn't compare to, for example, the Upper West Side or the Upper East Side, but it's something where you don't necessarily have to teach the consumer about FIDI as much anymore, whereas, Midtown, Bryant Park, you are going to have to teach them, I think, about the benefits of being in this neighborhood. But having all of these offices and corporate, organizations and companies really gives us a marketable base to kind of go after from the consumer side. And then from a physical footprint, I think it's really getting as much light and air as we can. And obviously this is a mid-block building, so it's not on a corner and we don't have four sides of light and air. But having on the north side, the south side, we're essentially adding to the building, and, we can touch upon some of the construction stuff, but coring into the building. So really getting something that can provide, and we're able from a construction standpoint to provide as much light and air as we can, so that, ultimately our finished product is marketable to tenants and a place where they want to live, and frankly, hopefully long-term, renew, stay in the building and kind of create that community.
And just briefly brought up FIDI. I mean, 20 years ago, nobody would have thought of living down there other than Battery Park City, but now people are living on Wall Street, Water Street, where you have a couple of properties. But let's get back to, the light, which is always the biggest issue outside of plumbing. Are you boring a hole? Are you going through? Or are you going to keep it as it is?
Yes. So this project, we are creating what we're calling a light well. And there's a couple different ways that, conversions look at creating units that are more, marketable and actually livable for tenants. And there's really two approaches. One is creating a light well, which we are doing here, and one is creating essentially a void, so a mechanical shaft within the building that there's no light and air. And the purpose of both these things is really to shorten the depth between the window wall of the building and the back of the unit that you're going to be putting in, right? As a resident, if you are extremely far from the perimeter of your space, it's not really a condition that you're going to want to live in. And from the New York City perspective, you need light and air in an actual room to have it be a bedroom, right? So if you have these really deep floor plates and you have rooms in the back, those are what we would typically allocate to the home offices, the spaces that are not technically legal bedrooms, but still space for tenants. So at this project specifically, we're coring out a light well, not through the main portion of the building, but a little bit off to the side. And what that will allow us to do is essentially have units that are facing inward. So we can have bedrooms both on the exterior of the building as well as the interior in the building, and really allows us to fit more units in there. And from the city's perspective, have units that are legally, have legal bedrooms. So rather than having studios, maybe now you can have that 2-bedroom or that 1-bedroom that has the extra depth to it. So that is something that we employ on all of our projects. And I think it really, depending on the configuration itself, so kind of going back to this building is mid-block. So we need that light well because we only, as is, have 2 sides of light and air. And this allows us to kind of create a little bit more of a bonus within that.
Okay, so let's it also doesn't hurt that it's less than a block away from Grand Central Station. So that location is that's a rarity in general. So I mean, people can commute out to the suburbs as well to go to work. So let's get back to let's talk about location. We all know it's location, but this is a little specific to this particular type of real estate investment. You mentioned Boston, San Francisco, Seattle, New York. I think there was another city in there. You're looking for high density areas. I get the feeling that the secondary and tertiary markets with excess office space may not be as attractive. Maybe you can give us a kind of, maybe Palmer or Adam, maybe you can give us kind of a perspective on that.
Yeah, absolutely. And I can give you my take and then let Palmer have his. But when it comes to these investments, our capital typically looks at the yield on these investments. And in a city like New York or San Francisco, Boston, you do have these great rents that are coming in. These are all really, the supply-demand imbalance in all these cities really points to the need for more residential units. But the costs generally for ground-up development are extremely expensive and time-consuming. So you have developers scratching their heads and saying, the rents are there, but it's going to take me 36 months to get my permitting and my groundwork in place to go belly up, right? What we have here, the office to resi conversion, we have a shorter timeline, and the permitting in a lot of these cities is much more efficient. So that's why we love these high density, high rent, these cities that have these imbalances in supply and demand. However, when you look at a city, I'll give Denver as an example. Denver, while some pockets are great for residential, the downtown in Denver is not a work-life play area. The rents are not great. And even while some of the buildings that you're looking at are trading for $25 a foot, the cost to build it, it doesn't, the ends don't justify the means. You can't really get there from a return profile. And it's not about the price of these buildings. It's about making sure that you can get the rents and that renters are going to want to live in the downtown of some of these areas that really is just not going to be a focus on many of these renters.
Well, maybe you could talk. Also, I never thought I'd hear New York has a speedy permit process versus any other city.
You'd be surprised. We're doing a lot of we're having a lot of conversation in Boston right now. Boston specifically, their office to resi program, what the mayor has done there is she's given permission to a group that specifically runs the office to resi process within City Hall, and they're getting permitting that usually can take 2 to 3 years. They're getting it done in 3 to 6 months. And we've seen this real time. We've sat with the city. And when you have such a great initiative where they're bringing the fire department, they're bringing in their inspectors, everyone to one meeting, going around the table, does anybody have any questions? Otherwise, let's get this permit moving. When you have something like that, it creates a real opportunity for groups like us to go and get our hands dirty.
And I'll tell you, with the cost of capital and the time of capital that it costs, that cutting down from 2 or 3 years to 3 months certainly increases your return. So Palmer, I'd like to hear more about that as well.
Yeah, I mean, just talking a little bit about the timeline, it's not just the kind of the pre-development work and approval timeline that's compressed. Like we're also seeing just the general construction timeline compress, and it's pretty intuitive. If you're taking an existing building that's already in existence and you don't have to build the foundation and you don't have to build the superstructure, you're bypassing that part of the construction phase. And obviously, there's a little bit of additional work in terms of the demo that needs to happen. But generally speaking, by the time the lender is getting involved in closing, the speed from loan closing to that initial TCO phase is compressed for these conversion projects relative to traditional ground up. And obviously that varies depending on how, the scale of the project and how large it is. But from a lender's perspective, being able to come in and make that investment and have a shorter time window to becoming a cash flowing asset and generating income definitely de-risks that part of the investment.
And so I would imagine your team is aware of a lot of the legal issues within these municipalities, or usually the developer that brings it to you.
Yeah, I mean, by the time we're getting involved, the developer generally has their business plan and has elected what type of, to the extent the location of that property has some sort of incentive program if they want to participate in that or not. And so, we obviously need to make sure that we're on board with what the business plan is and in agreement. But generally, that's been decided by the time they're looking for financing.
And so Adam, I just want to get back to you for a second. You did mention Denver, and you did have sort of an anecdote about whether it pencils out. You want to give us a little story on a building you were looking at there?
Yeah, there was actually an interesting case study. We had these two buildings that were connected to each other. Between the two, I think it was 1,006,000 square feet of office, probably 20 to 30% leased. And the owner was looking to sell it quickly. It was a lender-driven sale. And they were, at first, they came out and said it was $40 a foot. We said, this isn't going to work. A few months later, same building comes across. It's now $10 a foot. We ran the math, and we would actually need them to pay us to take the building and convert it if you wanted to get the math to pencil. At a certain point, if the rents aren't there, if you don't have any tax incentives or any help from the city, and the rents aren't there, there will still be office buildings that are obsolete, and you can't convert it to a residential. You can't convert everything to residential, even with the right layouts and the right floor plates and the right basis. It takes more than that to get from start to finish. I know there are groups in the world that are saying, all right, fine, residential doesn't work. Can we do office to a data center? Can we do office to self-storage? How else can we get creative? And maybe some groups will find ways to get creative. I haven't seen any office to data center conversions to date, but there is an office to self-storage deal that's happening. Another group's doing in an area in New York City where the zoning didn't work for residential. So we'll see some interesting plays for office buildings and different types of conversions, but not every deal pencils.
Okay, and so we do have a question based on legislation. What can New York City learn about the way that Boston has cut down the approval process? What specific things can be done in New York City?
Yeah, so I can speak quickly to that. So our team, when we went out and had our initial conversation in Boston, the development team, their jaws were on the floor when they were hearing to what extent Boston is willing to work with developers. It's really just having the speed, and it seems like in Boston, what they're able to do for these conversions specifically is everyone is on the same page. Instead of meeting with each specific group within the city on ADA compliance, and then you have the fireman chief come in and make sure that they're on board. It's one meeting with everybody, and that allows for everyone to really be on the same page. Where in New York, the system, it's a massive system, and it's easy to get lost and tangled in the webs. And obviously, we work with the city here and have expediters and do everything we can, but there's much more of a lengthy process. It's a lot more bureaucracy. And Alex, if you have any?
Yeah, I think it's, to Adam's point, like a little bit of a segregation between city departments. And, when they have queues and queues of other landlords and property owners in their face, despite having expediters and partners and relationships in the city, at the end of the day, there's only so much you can push because everyone's trying to weasel their way in. And to Adam's point, in a city like Boston, where, conversions are maybe a little newer, on the scene, for the city to help out, I think is really beneficial for them, because you're kind of like kickstarting a program, right? And they want to prove it out and get it going and have developers want to invest in their city. Whereas in New York, you know, as much as the city is a proponent of housing and conversions, you know, there's still a lot of development, a lot of real estate in the city. And at the end of the day, you know, we still fall into the category of millions and millions of square feet that are looking to be repurposed, reused, released, sold, bought. So I think our view is, you know, as much as New York City can, all these departments work together would be great. And, you know, it's really us leveraging our relationships within the city, as well as really our expediters and our teams who can try to push as much as they can.
Well, I want to get to some of the other city as well, because Seattle kind of is reflective, kind of an echo of New York City. And, you know, we have been able to get this process through something called the City of Yes, which was the current mayor's program. And if maybe you could give us a little update on that, because we had an election, we may be going from the City of Yes to the City of uh-oh. And so I'm wondering, for those out there, that we are kind of under the microscope of what policies can stay in place. You know, this is new construction, so it's not rent stabilized construction or rent controlled properties. So maybe you can kind of give everybody a primer on what you're looking at in terms of the next administration and how will it affect your ability to make these types of things happen.
Yeah, I think, you know, without getting too much into
Right.
politics, I think
Right.
generally
we have a thing that happened. We had a thing that happened, and we have to do it.
Have to prep for it. I think our take generally is that, you know, we are firm believers in New York City, and we're long on New York City. And I think it really just, you know, a really good example of this is, complete anecdote, we had a group of interns this summer at our office. It was a group from Cushman & Wakefield, a group from JLL. All of these interns go to colleges around the country. Most of them, 95% of them, do not live, you know, their families are not from New York, maybe not even the tri-state area. And we asked them, hey, after you graduate, you know, how many of you are looking to move to New York? And every single person raised their hand. And I think it's a good indicator that despite what's happening in the political realm, people want to live in New York and people are moving here. And New York's a pretty resilient city. And I think 4 years, you know, isn't that much time, right? And by the time we're actually through with construction and into lease up, we're going to be at the back half of that 4-year period. And I think, you know, Mayor de Blasio was here for 8 years. People have differing opinions on him. You know, I think it's our take is if we can make it through all these historical things that have happened, you know, we still feel that people want to be in New York. People want to live in New York. And, you know, we're not shying away. And I think we're optimistic and we're hopeful that, you know, there will be bipartisanship amongst everyone and try to put in policies and procedures that really benefit the city, because at the end of the day, we are proponents of new housing, both affordable and not. And, you know, this project specifically is making use of the city's 467M conversion program, which will require us to put 25% of the units as designated affordable, which is important to us. It's important to the city. So someone like, you know, future incumbent Mandami, you know, we believe that he hopefully will continue these types of policies, because yes, we're creating new development and market rate, but we're also putting in, you know, 150 affordable units just to this building alone.
And so when you talk about affordable units, which is obviously so necessary everywhere across the country, are other cities like Boston, Seattle, and Chicago, San Francisco, are they requiring those types of affordability units as well?
Yeah, so every city is different. So in New York, you have 25% affordability component. They'll give you a 90% tax abatement for 35 years, which we believe to be an
Can you
extremely
repeat that
accretive
again
program.
about the tax abatement? Because that's something that really
Yeah.
needs to be really slowly said.
Yeah, 90%. So it's a 90% tax abatement for 30 years, and then the last 5 years from 30 to 35 slowly draw back down over time. But it's, you know, on a building like on 43rd Street, a total tax amount that may have looked something to the extent of $10 million, you know, we're going to be paying $1 million a year, and that obviously is a major driver in this deal, a major driver for the type of investors who will want to own this deal after, you know, whether we refi or sell it. There will be a number of people who are interested in owning a building that has the kind of cash flow that this will allow. So that's a major part of this deal. So New York has that program. Boston, very similar, has a similar tax incentive, 75% tax abatement for 30 years. And you'll have 20% affordable units in Boston. And interestingly, in San Francisco, for example, they'll waive any ground up building has to have affordable units, except for office to resi conversions in San Francisco. You can convert the building and have it be fully market rate, which is different from any other building that's going to go up in San Francisco. So every city is a little bit different, but the cities that have these accretive programs are the ones where you're going to see continued office to resi conversions.
Interesting. So along that, we've got some questions coming in from the audience, which is wonderful. To build, let's see, what types of returns are you underwriting to, and what kind of time frame for those returns? And does the exit strategy vary from a more conventional development?
Yeah,
Palmer, you're underwriting stuff, so you have to look at this as well. So who wants
to comment on the equity returns, and I can talk a little bit about kind of the debt market afterwards, if that works.
Okay, that's great.
Sure. So I'll quickly touch on how we underwrite. So it varies city by city, but for New York, let's say, we're looking for a yield on cost of ranging between 6 to 7+% IRRs. Because this is a time compressed deal, we're underwriting to mid-20 to low-20 IRRs net to the investor. And it's usually a hold period of 4 to 5 years, where a timeline looks something like 6 months of pre-development work, 6 months of pre-development work while we have our financing ready to go in place, depending on the deal. And then construction can be anywhere between 12 to 24 months. At that point, we are leasing the building as we finish floors. So let's say we finish floors 2 through 7 are the first floors we'll finish. We'll have tenants moving into that building as we're completing floors 8 through 20, call it. So you're rolling the building, leases are rolling in, and you go to sell this building at the end of year 4 after you're on your second renewal period. So you have real rents in there. You're burning off on your free rent if you're giving a month or 2, which is pretty common in New York City. And you're selling a building at the end of year 4, hopefully what is a 95% occupied building with little to no taxes being paid on the property. And the exit looks just like any other exit of a multifamily building, other than, of course, the fact that you have this amazing tax program that will go to the next buyer.
So it does go to the next buyer.
At this point, we'll have 30+ years.
So
yeah,
the grandfather in, so the next acquirer gets that advantage. Palmer.
Yeah, and I mean, the one thing that I'll add to that, just on the exit, I mean, when you look at the finished product of these conversions, they're indistinguishable from a traditional multifamily. We worked on a project that completed semi-recently with the Vanbarton team in the financial district, and it's one of the nicest apartment buildings in the city today. And so, in terms of the exit and liquidity, like we're seeing demand from investors in the same way you would a traditional apartment asset. And one other thing, just in terms of the deals that we tend to focus on, just since we're talking about kind of liquidity and exit, the size of these can range, greatly from really small opportunities to incredibly large opportunities. Where we've tended to focus is really finding that happy medium in the middle ground of a project that's large enough to get the economies of scale that you need to benefit from kind of a cost perspective, but also not being so large where you are limiting your liquidity on the back end in terms of either getting refinanced out or the property being sold. And so we've tended to to gravitate towards kind of some of the mid-sized projects, and also those mid-sized projects from a lease-up perspective are able to stabilize much quicker too, and you don't get into kind of the revolving door of running into the initial leases that are expiring before you reach stabilization. I guess going back to the cost of capital question, on the debt side, it varies depending on what the sponsor's leverage point is. And every deal is going to price differently on top of that, depending on what market it's in, what the size of the transaction is, obviously the leverage point the sponsor is looking for, but also who the sponsor is. Someone like Vanbarton is that's an experienced sponsor with deep lending relationships is going to get a better execution than a sponsor that doesn't have the benefit of that experience in those relationships. But overall, depending on the leverage point, if it's a lower leverage senior execution and call it the 50% loan to cost range, it could be in the high 2s, low 3s, or compressed from there if the borrower is willing to offer some sort of recourse. In terms of alternative lenders, where we typically play in kind of the 65 to 70%, I would say generally in the mid to high 300s over SOFR, and then it can go up from there depending on how much more leverage someone's looking to get.
Sure. So another question is, on the average, how much does it cost you per square foot to convert commercial to residential? Or are you required to ever, by the city, to ever allocate a certain? Yeah, we already went over the low income, but what does it cost per square foot to convert, and is it different in each city based on whatever construction costs are?
Yeah, absolutely. So it is different in every city. So it'll depend on a few factors. Obviously, the type of building you're going after. So Pearl House, for example, are building in a financial district, a building that has amenities that I would say are top tier in New York City. A spa, a sauna, a steam room, hot tub, that kind of thing. So when we're looking for a luxury building, a conversion that looks like that, your costs are likely between $300 and $365 a foot of hard costs. So on top of that, soft costs and financing costs, you're all in from the conversion outside of your purchase price. You're probably talking about roughly $500 to $550 a foot in New York City. And that will often include building floors on top of the building. So as Alex mentioned, we'll core out a building or do these blind shafts. And what that allows us to do is reallocate building to the top portion. So you're taking out a block from the middle of a Jenga building and putting it up top and allowing for these penthouses that are getting some of the best rent in the building. So that $500 will also include the fact that we're building 6 new floors on 43rd Street and some of our other projects as well. So that's how we look at New York, some of the New York costs. In Boston, for example, a much heavier union town, some of those costs will be more expensive, while in some locations on the West Coast, maybe your cost of labor might be a little bit cheaper, but there could be other unique union costs as well. So it really does vary city by city. But I'd say New York, Boston are probably on the higher end of the cost range.
And so, that speaking of costs, I mean, have tariffs affected you at all? Might as well throw that in. It seems to be affecting builders all over the country.
I think for our project, luckily, it hasn't had too much of an impact. And really, obviously, April earlier this year, we were kind of in still the pre-development stage for 2 of our projects, obviously 60s 43rd, which kind of the case study here, we didn't actually close on until the very, very end of September. But what we try to do is really manage the process ourselves and work with the contractors directly to really bake it into their pricing. So us as Vanbarton, we act as the developer, meaning we hold the contracts with all of the subcontractors and general contractors that are on the site. We do utilize a third-party construction manager to manage that process for us and really control everything and oversee the day-to-day. But with us being in the developer position, we negotiate directly, with our construction manager, with these contractors, and will oftentimes bake in provisions and other things that is, locking in a price ahead of time. So, this was March, April, and then, May, June of this year, when a lot of things were in flux and there was a lot of uncertainty, is really baking in prices from the start and, either pushing some of the cost onto the contractors, splitting that cost. So I think getting ahead of it for us on some of our other projects that are ongoing allowed us to defray that, as well as volume, right? So economies of scale does exist with these projects. So when we have 2, 3, hopefully more, in the future coming online, and we need to purchase steel to, reinforce the building so that we can add load to the top on these new structures. If we were building a 100,000 square foot building on a one-off, we wouldn't really get competitive pricing. But when we're buying for, 3 buildings that are, call it 500,000 square feet each, that's a lot of buying power that we can use and go to vendors and say, hey, if you want to be as competitive as your competition, we're going to buy all these projects together, or at least price them together and get economies of scale. And I think that's a way that we leverage other projects, and existing relationships is huge. Going with contractors, and especially our construction manager, who we have existing relationships, who can press a little bit and know that the groups that we're going with are going to, essentially be honest and, when push comes to shove, work with us down the road. But, I think it's all these factors and really a confluence of things, of relationships, economies of scale, and really thinking about it ahead of time and trying to be as proactive as we can. A lot of times you have to be reactive, but really trying to get ahead of it. And obviously since then, a lot of the tariff conversation has subdued a little bit, but when, politics and macro environments can change in a drop of a hat, you have to be prepared. But I think for these projects specifically, we've gotten out ahead of them to the best we can.
Okay, so let me ask you another question is, what is the longest lease term you're able to achieve with residential tenants? What do you look for? Are they 6, 12, 24 months? What is ideal for you as an investor? And then when you eventually exit the property, what are people looking for when you said recurring cash flow, 95% lease, but how long are those leases?
Yeah, I would say, New York is not dissimilar from most places, where you're really looking for 12-month leases. But when you're initially leasing up the building, so, the building is still under construction, you're having tenants move in, trying to get a good amount of 18 to 24-month leases is actually very critical for the beginning of the project, because what you don't want to have happen is you have all these tenants moving in, with concessions, free rent, maybe some free amenities, and year 1 of full operations, right? So now the building is leased and you have tenants coming up for renewal. What you don't want to have happen is every single unit in the building you're negotiating with, they're up for renewal. Now you have, 3 to 5 move-outs every day, maybe, more per week. So it's really staggering in the beginning that kind of maybe some of the moderate to long-term leases, so 18 to 24 months, so that when you're in your first year of stabilized operations, you're not renewing everyone in the building. You can kind of manage it from an operations standpoint, and from a supply side, everyone's not rolling at once. So you maybe have half the building rolling in the first year of stabilized occupancy. You kind of get them working through, and then year 2, you'll have these first generation tenants then up for renewal. So I'd say in the beginning, it's somewhat of a split. It's still more heavily 12-month term weighted. And then once you're through the lease up, typically then for renewal, 12-month renewal, maybe 18 months if you're going to work with the tenant, if they're trying to move to another city. But that's typically what we look for. And then obviously Palmer, from his side, we typically have requirements about, no leases shorter than 6 months, or we need approval if there are month-to-month leases. So it is a little bit of a dictated from the lender side as well.
Palmer, you're on. Talk about what requirements you look for lease term.
Yeah, no, I think that's right. I mean, the typical market convention is, 12 to 24 months for a, traditional residential lease.
And
You
these are
have,
none of these are rent stabilized in any way, except for the lower income affordable ones, correct?
that's right. I mean, even the affordable units are going to be 12-month leases too.
Okay.
Um, So, from a lender's perspective, you do have, some operators who want to try to find an opportunity to see if there's other ways they can drive additional revenue at the asset to create value. Often people will look to say, okay, well, maybe I can take a subset of my units, furnish them, and operate more as a short-term rental business plan. And that's generally executed by partnering with an operator and having an operating agreement with them where there's a revenue share for those short-term units. And so when it goes well, that could potentially create additional revenue relative to a traditional multifamily. But it creates risk because if that's not a successful business plan, then you could be getting all of those units back all at once and creating some additional vacancy within the asset that needs to get released. So from a lender's perspective, where we're more focused on downside protection, we very much prefer to be involved in transactions that are just traditional multifamily.
Just getting so many questions, but I have one for you as well. I mean, Alex, you brought up amenities. That seems to be, I mean, I've gone to a couple of these conversions and it seems like they're more like luxury hotels now versus conventional apartment buildings. Are those a la carte services? Do the tenants have to pay for these add-ons? Like you said, spa, bowling alley, and hydroponic farms, which I've seen in some of them. Are you I mean, is there like an upsell for all of these? And Palmer, do you also look, is that part of your calculus when looking at these things now?
Yeah, I can give our perspective first. So, it is different for different landlords, but typically, and what it is for us is the amenities are a fee that tenants, for the most part in our buildings, are required to pay. So for example, Pearl House, which is, now a finished stabilized building, we have a bowling alley, we have lounges, we have golf simulator, we have a roof deck with loungers, grills, private kitchen. We essentially, it's, anywhere, that building specifically, for example, is $120 a month. Different buildings have different ranges, but it's a mandatory $120 a month that you get for access to everything in the building. And it's a pretty good value proposition when, you're having a pretty state-of-the-art gym, for example, that in the city, when you have Equinox and Lifetime Fitness and other gym memberships that may cost $200 a month, there is a little bit of a value proposition there for renters. And then in some instances, if you're having a private event with your friends, your family, and you want to rent out a lounge or a room, that's typically a separate fee. X dollars per hour for set number of hours. But that's typically how we look at it. So it is actually a pretty significant, value driver when you're having $100 to $150 a month for, if you have a building, Pearl House has 588 units, you can have anywhere from 700 to 800 residents actually living in the building. So $100 to $150 a month for 750 people is a lot from a value perspective.
Up. Just as an aside, do you charge the affordable tenants, the affordable rent tenants, the same amount?
So they can elect. So for them, it would not be a mandatory fee, and they would more or less elect to go into that at a discounted rate.
Okay, that's so. Another question. I guess we're going to talk about NIMBY. Is there any of that issue, or people, or like the neighborhoods? They're happy to see you come in.
I think anecdotally, mostly we've had groups that are pretty happy for us to come in. It's kind of funny some of the responses we got. So 60th 43rd, we call it Project Fireman because there was a large fireman statue outside. There's a whole story behind the statue. It was actually supposed to leave New York right before 9/11. I think it was going to St. Louis, go to the fire academy there. And
which
after
address?
9/11,
which address is this? Which building?
On 60th 43rd.
Oh, okay, 64. Okay.
So we called it Project Fireman because there was this large fireman statue outside. And when we bought the building, we actually made the decision to donate it to the Fire Academy of New York and take that massive statue and bring it downtown to go there. And we actually got a bunch of emails from some people who were fairly upset saying, hey, I know you guys bought this building. This beautiful statue is here. It was emotional. I had to do, it was came here after 9/11. And we had to email and let everyone know, hey, we actually donated to the Fire Academy. We were aware of its significance. We want it to go to its proper home. We now have a little sign there that says, hey, the statue that was here, if you're getting upset about it, just to let you know, we donated it. It's in its rightful home. So in terms of opposition from converting an office space, very little. But, we've had here and there people ask questions. What are you planning on doing with the space? That kind of thing.
Palmer, you were going to...
Yeah, I was just gonna say, I mean, overall, I think people are generally excited about these types of projects. So you're taking a asset that is, not fully utilized as in its existing form as an office building, and really kind of breathing new life in it, and revitalizing it, and therefore improving the broader neighborhood that's a part of and activating it. So, I think people are by and large very much supportive of these types of projects.
And with one of the questions I just saw is say, like 1640 3rd Avenue, was it 1st Avenue or 3rd Avenue? 3rd Avenue, that's way uptown, right? So that's actually in a neighborhood area. But when you're looking at something like 6 East 43rd or Pearl House on Water Street downtown, is the advent of converting these properties to residential, is there a cascade or a waterfall effect where other retail establishments are now moving in? Is it creating that type of neighborhood experience?
Yeah, I think definitely, and kind of going back to something you said earlier about the financial district as an example, where 10, 15 years ago, it's pretty much exclusively seen as you go to work, you come home, and you leave the financial district, 5 o'clock comes, there's nothing open. And as a lot of these conversions downtown, for example, have come about, it has brought new retail, new life to those neighborhoods. And, when all these conversions are happening, the immediate reaction is, hey, there's a lot more supply, there's a lot more competition, and it may spook people at first. But our view is that it's really, from a long-term perspective, critical to having a better neighborhood that people want to live. So the more conversions, the more residential buildings that are built, the Whole Foods will come, the Trader Joe's will come, and then people will live in these neighborhoods that, aren't dark after 5 p.m. Now they're lively and there's places to go. So downtown, for example, you have the Tin Building, which is in the Seaport. It's 5 blocks away from Pearl House. That didn't exist 5 years ago. Now it's there, and it's a great attraction. There's groceries, there's a lot of tourists that go there. So in these neighborhoods that aren't typically seen as residential, having these buildings converted and breathing new life into the retail in the neighborhood is really what we hope for, because, last thing we want is to convert a building and you have retail on the ground floor next door that sits vacant, because it doesn't do anything for anyone, and it's, not really what we would look for. So it is a key thing to think about.
So going back early in our conversation, as we're coming close to winding down, you mentioned that there's certain buildings that are available, and there were a lot of studies during the pandemic and after the pandemic that only a certain amount of the stock was available could be converted to residential use. Are you finding more and more competition in this particular niche within the real estate industry? Are you finding yourself priced out, or are you still sort of ahead of the curve? What are you seeing right now?
Yeah, it's actually really interesting, and I feel like it changes with momentum quite often. So I'd say we're on any building that we like, we always find ourselves at the top of the competition in terms of being able to price out a building. But what we are seeing right now is office, to be kept as office, is really starting to make a comeback in New York City. And what that's doing is starting to drive up pricing on office buildings. So some of the pricing that we had seen a year and a half ago, those buildings are starting to become a little bit more valuable, one, as an office building, but also to those who are starting to understand, wait a minute, I have a building that can really be converted here. And it gets interesting because a building that is completely empty, right, sitting on First or Second Avenue, call it, is actually worth a lot more than a building that's sitting full, is the way that we'd view it. So you're actually in a bad situation when you have a building that's 50% leased with long-term tenants, because you're probably not really covering your debt service. You have money coming in, but not enough. Nobody can convert it because you have leases for another 20 years. Those are the groups that are in trouble. If that building is empty, you're going to have 10 bidders try to convert it. And if that building's full, at least you'll have that cash flow. So you're kind of better off being here with an empty building or a full building, but it's that middle ground that's kind of in trouble. And then secondly, as these office buildings get converted, actual office tenants are sort of, trying to find a new home for themselves. So Third Avenue, for example, which is an office quarter, there are 5+ buildings right now that are in the middle of being converted. There are millions of square feet of office buildings that are going to become residential, which is going to be great for the neighborhood. But all of a sudden, you're going to see those Third Avenue firms make a decision. Do we want to go to Park Avenue? Are we going to go to Hudson Yards? Are we going to go to First Avenue by the UN? Where's their next home? And you're going to see that demand for office, we believe, is going to continue to grow as New York goes through this transition.
So well, I think we're almost winding down, Palmer. Just finally, I mean, talking about what Adam said, and these buildings, these tweeners that are kind of caught in a debt zoom. What is your advice for them, other than, I mean, you don't want to take them back, obviously, but are you kind of saying, okay, we have partners that can take this building off your hands and convert it, or where are you going with that?
Yeah, I mean, listen, for buildings that are caught in kind of that mid occupancy level where there's not an immediate path to doing a conversion and they're having trouble finding tenants to lease, really those owners are trying to maintain as much flexibility as possible. So when they're bringing in new tenants, they're trying to negotiate termination options so that if they're able to line up the existing rent roll in a way that they can create a path to either for themselves or for a new buyer to do a conversion, that's the ultimate goal. And so, those owners are kind of working through what their options are to try to minimize the amount of basis creep that they'll have for carrying an asset that's not, producing enough cash flow to be cash flow positive, but also not in a position where it can immediately be converted.
All right. Well, it looks like what a fascinating session we had here at the College of Real Estate. It looks like our 2025 Global Chair is back to take back the reins. Adam and Alex and Palmer, I want to thank you so much for this illuminating afternoon. John?
Yeah, wow. Thank you, Jonathan, Adam, Alex, and Palmer. Boy, this was a jam-packed session with lots of good information. Your equity and debt strategies in the commercial conversion space are a testament to how vital adaptive reuse is to local markets and the industry in general, especially today. A counselor of real estate is a link between defining a problem and devising a solution, who sees the big picture, connects the dots, and resolves uncertainty by creating a framework for decision-making, an agenda for action, and a roadmap for success by answering questions like, what should I do and how should I do it? CREs are inveterate problem solvers, prepared and equipped to help their clients and employers capture opportunities and devise solutions to complex real estate problems. I would encourage you to consider engaging a counselor of real estate when seasoned advice or a solution to a complex real estate matter is needed. Perhaps you might even consider becoming one of us and seek an invitation to membership and the CRE designation, a badge of distinction, and a commitment to excellence.
And
you can contact Lindsay Adams.
Background too. You get the background.
Yeah, that's right. You get this cool background too. And you can contact Lindsay Adams at ladams@cre.org for more information. Please join us December the 10th for our final webinar of the year, hosted by our wonderful host over there, Jonathan Schein, a special year in review presentation. You can register for this at cre.org. Until then, on behalf of the Councils of Real Estate, Jonathan Schein, and everybody else here on the screen, thank you for attending this session of What's Next for Real Estate and the Life Experience. You all have a great day. Bye-bye.
Thank you.
Thank you.